Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go. Welcome, everyone, to another edition of SHP Financial's Retirement Roadmap podcast. I'll be your host today, Matthew Peck, joined by my partner, Keith Ellis. How you doing, Keith?
Good. How are you, Matt?
I'm doing very well. Happy
Excited
to be
for
here.
our guest.
Yes, absolutely. It's a recurring guest. I mean, he's been here before, and so I guess we didn't scare him away.
He's a veteran. Yeah, we didn't scare him away.
We didn't scare him away at all. Right. So for all of our listeners right now, if you have questions about the residential mortgage landscape, thinking about things like home equity, or are we going to buy a home, and what are the rates going to be, and what type of strategies there are to navigate the higher interest rate environment. Are we anticipating rates to be cut in the future? As we talk a lot about it on the financial planning end of things, but what are the mortgage brokers out there looking at? As I mentioned, we are joined by Nate Hartseil. He joined us before and kind of walked us through his background in this space, but he represents Main Street Home Loans. If hopefully I got that right, Nate, you're going to have to, obviously I'm not a professional at this either, as you can see. But he's been in the field now for many, many years, and he's a recurring guest to kind of help all of our listeners walk through the current mortgage landscapes, what options are, buying a home, selling a home, whatever that may be. And so without much further ado, Nate Hartseil, thank you for joining us again.
Well, Matt, Keith, thanks for having me. Long-time listener.
Yeah. I appreciate that. We have one or two, yeah.
I don't know why we laughed at that. He probably, hopefully he's a long time listener. You know what I mean? Hopefully that's not a joke.
Yeah. So Nate, okay, so here we are coming into 2024. What are your expectations? I've heard things were slow in 2023, and was that purely because of interest rates, or was there other factors at play? And how does 2024 look?
Well, great question. And, it's a better time to be here than last time, because I think last time we were in kind of the downswing, and now we see light at the end of the tunnel, which is really, really good. There are some factors that are playing into kind of a stale market right now. Refinances are up because U.S. personal debt within households has exceeded $1 trillion for the first time in history. So over the last couple years, your average family household has acquired a lot of revolving debt. That being said, it's a good time to retire your debt. So cash out refinances and home equity lines just in the last month were up 36%.
Wow. Okay.
As rates continue to trend down. 2 months ago, if I was sitting here, we'd be at 8%. Mm-hmm. Now we're probably somewhere in the sixes, which is a big swing over a couple month period. The feds have came out and said that their intention is to lower rates 3 times over the course of 2024 and followed up into 2025. Now, Wall Street Journal kind of beat the feds to the punch, and they came out and predicted closer to 5 or 6 times in 2024 and an additional 2 to 4 times in 2025. Which should put us at a target by end of 2024, somewhere maybe around 5.5%. And with any luck in 2025, hopefully somewhere in the low 5s to high 4s. Okay. Which would really put a spark in the market we're at right now.
Well, and let me ask you that, because I'm aware that in regards to the Federal Reserve, we talk about the Fed cutting rates. I know primarily they're talking about the shorter end of the curve. When the Fed cuts rates, it's on the overnight lending. So it's on more of the shorter term rates. So how does the Fed cutting short term rates affect long term rates?
Sure. Great question. So the Fed, you're right. It will mostly affect cars, revolving lines of credit, which are extremely high right now. So it gives confidence in the market, and when there's confidence in the market, the bond market usually tends to do a little bit better. And when the bond market does a little bit better, mortgage rates are basically built off the yield between the long-term and 10-year treasury. Mm-hmm. So we should see a little bit of movement in the mortgage industry. Just because you remember when we were back and the feds were like at 1%,
right?
With interest rates, everybody was calling like, hey, can I get that 1% rate? It doesn't work that way. Mm-hmm. Mortgage rates heavily trend off the 10-year treasury.
Off the 10-year, not the 30-year.
the 10-year.
Interesting. Okay. All right. That works. And so, no, Keith, I know you have some questions too, but you mentioned also, Nate, about you said that the total amount of debt that households have. Now, is that because of the mortgages? Is that because of credit cards? Is that the impact of student loans? Kind of what's really driving that up right now?
Sure. Well, the cost, period. Inflation. Household expenditures has went up dramatically over the last 2 years, which people realized their normal salary, couldn't support their normal lifestyle or just kind of day-to-day expenses for your family. 60% of the U.S. right now is living paycheck to paycheck.
How many? 60%?
60%.
Wow. Yeah.
And another crisis we have in the mortgage industry right now is 70% of homes in the United States are owned by people 50 years old or older. Your average age of 19 to 29 years old right now, 60% are living at home with mom and dad.
Wow. Okay. That's a heavy majority.
It is. So what we have now is 30 million homes that need to be turned over from one generation to the next. But inflation is causing this younger generation
to kind of step away from the idea of home ownership, correct?
They are until either prices of homes come down, level out, inflation comes down, so the cost of expenditures comes down, or the everyday income goes up.
So it has to be one of those three factors that really kind of kicks it up.
But mom and dad can always give a nice gift of equity to their children.
And you mentioned earlier, home equity line and cash out refinance, and those are terms in that industry, but a lot of people that listening might not really know what that means or what the difference is. I don't know if you can expand on that a little bit, because I know they're both ways to kind of control or pay down debt, but I didn't know which one kind of worked best in this environment, or just kind of maybe an idea of what both are.
Sure. So predominantly, a home equity line of credit, which is a HELOC, is a revolving line of credit. What that means is it's close to a credit card. You can get by just paying the monthly interest every single month. Now, you never get anywhere paying it down. This is based off the short-term interest rate. So this would be based more off the Fed prime rate, which is 8.5 right now. So you're lucky on a home equity line right now to either get prime or prime minus a half. So you're talking 8 to 8.5% interest only right now on a second mortgage.
And
this is a second
could fluctuate, correct?
It
Typically?
It can.
Yeah, okay.
So this is a second mortgage on your home.
Yeah.
So it takes second lien position. That being said, right now you can cash out on the equity of your home because, let's face it, even though we've been in kind of a stale market the last couple years, especially in Massachusetts, homes have still gained anywhere from 4 to 11% in pure equity increase. So a lot of people, even if you purchased 2 years ago, 4 years ago, are sitting on a nice pile of equity right now.
Yeah.
And knowing rates are going to come down in the future, now is an optimal time to retire your debt. So if you're sitting on $15,000, $30,000 worth of debt, it's going to be cheaper in the long run right now to do a cash out refinance, say maybe at high 6s, low 7%. Because let's face it, your credit cards are at 22, 29,
yeah.
Right, yeah. Well, double digits for sure.
Exactly. So to retire that debt is going to free up more disposable income monthly for your family. Now, there's two types of refinances when it comes to your normal fixed rate refinances, and that's a rate and term or a cash out. A cash out will have a premium on the interest rate, so you pay slightly higher. But you only have to keep that loan for 6 months before you can refinance it again. So my company, what we have done recently, and a lot of companies have followed suit on this, knowing that rates are going to come down over the next, we'll call it 6 to 18 months, are offering a 5-year guarantee. When you do a refinance or purchase with us now, and then refinance within the next 5 years when rates drop, we'll pay all your lender fees and appraisal fee. Wow. So you can retire all of your debt right now by using the equity in your home, freeing up more disposable monthly income for your family. And then when rates hit 5.5%, 5% again, we can reset that mortgage back to a nice, comfortable rate for the remainder of the term.
Is that a one-time thing, or is it like, hey, now the rates are now I'm at 7, now I want to go to 6, then I want to go to 5, then I want to go to 4.5?
Keith,
how's
that's
that
what
work?
you do.
I mean, how's that work? Like,
So yeah, we can offer that multiple times.
Wow.
In the market.
That's fantastic.
Well, so all right, so let me make sure I understand you. So you have the home equity line where you have this open line and it moves up and down depending on how much you borrow. Okay, this cash out is you're automatically getting a certain amount coming out no matter what happens, right?
Correct.
So it's not like this, like, oh, you have an open line and you can borrow what you want. The cash out is, okay, here is a check for $50,000 or
20,000, whatever.
20,000, yeah,
Correct.
right. I guess, yeah. What sizes do you generally see?
It's usually up to 80% loan to value.
Okay.
So you'll take the value of your home
Yep.
times 80% minus what you currently owe on it, and that's how much cash you actually have to really do what you want. Purchase another property, pay off your debt, gift it to your 25-year-old still living at home in the basement so he can go buy a house.
Yeah, I see. So is it because, and I guess, do you see people do it for all those different reasons?
Well, I
mean,
do. And, commonly, which really applies to your industry right now, let's face it, the last couple months, the market's done really well. So it still doesn't alleviate the fact that people are still on hard times, costs have went up. So instead of tapping into your investments that are doing 7, 10, 15, 20%, you can take the equity out of your home, say high 6s, low 7s right now, and then your investments keep trading at a much higher rate to offset that interest.
And as I mentioned, this is, you could do it for any reason. So it's for renovations if you want to,
Correct.
or whatever that may be, or if you want to pay off a car loan or a credit card loan or whatever that may be.
Absolutely.
Okay.
And if you're afraid that you don't have enough equity in your house, and to your point about renovations, we do offer renovation loans.
Okay.
And this would be more specific to people without a lot of equity, because the renovation loan then is based off the future appraised value. So if
okay.
you're adding value in
Yeah,
addition,
okay.
or
That makes sense.
if you're adding value to the home, it's based off the end value.
Now, is that the same thing as a construction loan, or is that different?
It's different. We don't do a lot of ground up construction, but pretty much renovation loans, as long as you're leaving a foundation and a wall,
Yeah.
you
Yeah.
can pretty much modify the rest of the home.
And is that the whole idea of a construction loan? Is that kind of doesn't really common in sort of Eastern Mass, because generally you're seeing more renovations, or there's not a lot of homes to be built out here. I mean, the single family homes are no one's building them anymore. All right, so that's why construction or ground up, you said, aren't really common on the East Coast, do you think, or at least where we are?
Well, so we're a direct lender.
Okay.
And we do hold a very large portion and service it, depending on the market and where the market's at right now. Construction loans are kind of a whole different realm, because you're holding it longer and you're managing drawdowns. There's multiple appraisals as each phase of the development is done. So they're a lot more costly to do as well. It's basically a whole division that manages pure construction loans.
I mean, I think that's the biggest thing Keith was going to offer up before, but just more how big this universe is blows my mind, right? Because it's like you have, the construction side of it, you have the home equity line of it. People ask about reverse mortgages. I mean, it's like it goes on and on.
And then you talk about different types of loan. Okay, well, now we have fixed versus ARM, and I was wondering if you could expand on that a little bit, because a lot of folks are coming in kind of thinking the same thing, is like, hey, look, right now a 5-year ARM or 7-year, whatever, 10-year ARM, the rates are a lot, well, I shouldn't say a lot, but lower than your fixed. So what I'll do is I'll take an ARM, let the rate fluctuate. Hopefully the rates go down over the next 5 years and then refinance it. Is that common?
Well, it was.
Okay.
And let me tell you why, because the market didn't know where we were going until the Feds kind of made the last announcement, okay, we're ready to start cutting rates. When it was on the up and up, the ARMs were very, very prevalent, because the market anticipated that rates were going to continue to rise. Now that rates are predicted to lower, there's no money in short-term mortgages right now, because there's a 95% rate that any mortgage we wrote last year halfway through the year before, and any mortgage we wrote this year will be refinanced within the next 12 to 18 months.
Has to be.
Yeah.
It makes no sense not to.
The adjustable rate is really kind of leveled off with the fixed rate. And one of the reasons we're offering the 5-year guarantee is because the loans we're writing right now, we're lucky to break even on these loans. There's really not a lot of money in them right now. There will be in the future for the refinance. So it's worth keeping that client for the future.
Sure.
Okay, and then back up really quick. But in the cash out home equity, or that, sorry, is it called a cash out home equity, or what's the official term?
So
of it?
home equity line is the second mortgage.
Okay.
Cash out refinance is reworking your first mortgage
Okay.
on your home.
So that would be a fixed though. That'd be a fixed rate. So that's
You can do either, but predominantly a fixed rate.
Okay. Is there a traditional home equity that's fixed, or no? Home equities are always floating.
No, they do offer a fixed rate home equity, but once
Okay.
again, they're still based predominantly off the Fed prime rate,
Okay.
which is much higher right now, especially with the long term treading downward.
Okay. So that, all right. And then back to kind of like retiring debt that you mentioned, because I asked about like student loans, and Keith, I'm curious how it comes up with your clients, but it generally, I'd probably say like at least, I don't want to say once a day, but I mean, almost like every review, people talk about, hey, I have this car loan, should I pay it off, or this, I mean, credit card loans are pretty easy, right? I mean, obviously anything 15, 18%, yeah, pay that off first. I guess, how often, I mean, is it mainly renovations like we're talking about, or is it when people retire debt, is there one thing besides credit cards, which is the obvious one, are there other debts that people target? Is it the car loans? Is it the student loans? Is it, how do you see people using that tool?
Sure, great question, because it really has to do with the current market. Mm-hmm. When car loans were at 2 and 3%, nobody cared.
Yeah.
Car loans now
Right,
6, 8,
right.
9%, people care. So I do see a little turn in what they're geared for now. When rates were low, everybody was cashing out to buy more properties. Now I do see it mostly credit card debt,
Okay.
revolving debt, things you just can't get out from under because, if you owe $20,000, $30,000, you can make that minimum monthly payment and still raise your family. However, if you want to get anywhere with that, you need to make large chunks, so you're really not getting
You're
it.
running on a treadmill.
No. Yeah,
Yeah,
exactly.
Yeah.
And you can spread that over 30 years with a fixed rate on your mortgage. And we can show blended rates, short-term, long-term. So with clients, we can do a complete financial analysis and show them the benefits and, maybe some of the best things to pay off, maybe some of the not so good things to pay off.
Right. Because I was going to say, especially Keith, I don't know how often you see it, but I'm surprised that very often I do have clients that come in with $5,000, $10,000, sometimes $15,000 worth of credit card debt. Even savers will sometimes come in. They'll have a lot saved, but then they'll also have credit card debt. And I think it's by far just the, maybe it's the whole slippery slope thing, but it's just such an easy thing to just pay
Sure.
off or pay a little bit here. And
Yeah,
then just
people
lose.
want to keep their lifestyle. You know what I mean?
Yeah.
Even in this rising inflation environment, I don't see many people cutting back what they used to do, which then if your income isn't going up as much as inflation, or you were barely getting by prior to this recent spike in inflation, you're going to accumulate debt. And it's like, what is the best way to attack that debt? I mean, I have a client right now, he's accumulated probably $15,000, $20,000 in debt and on a credit card, and he just rolls it over every 6 to 8, maybe 12 months into a 0%, and then he aggressively attacks it, 0%, aggressively attacks it. So he might have a Visa, then an Amex, then a MasterCard, back to Visa, and until it's gone. I mean, if you have the patience and the wherewithal to do that, which good for him, and it's very smart strategy to do that. It's probably the best way
For people who can do
that. Exactly. That's
what
the
I've
other problem,
experienced
right?
now with people
It's
with
very
high
hard.
credit card balances.
It's very hard to do that. Very hard.
Exactly. Even if you pay your debts on time and you're making minimum payments, anytime that revolving credit line goes over, we'll call it 35% of
Yeah.
the high credit limit, your credit score starts to come down.
Yep.
As your credit score
It's
starts
harder to
to come
obtain
down,
the 0%.
nobody's offering
Yeah.
you that 0% balance transfers anymore. So mortgages are still easily obtainable.
Yeah. No, I agree. And as we start to look at forward-looking in life, financial planning, some of the things that, recently I've been running up against are, believe it or not, people that don't have, children. They just don't have any kids left behind to leave anything behind to. And, their concern might be long-term care as they age, right? And I start to talk to them a little bit about the idea of using their home equity to pay for long-term care. And one of the, I guess, aces, up their sleeve, I guess, for lack of a better way of putting it from a financial tool standpoint, could be a potential of a reverse mortgage. And this doesn't have to be just for folks that have no family to leave money behind to. It could be for really anyone. So, and I think it is, it definitely has, I guess, for a lack of a better way of putting it, kind of a black eye in our industry, the way that people think of them and the way that consumers think of them. But it is something that at some point, someone might have to, raise their hand and say, look, I got to use this. And, I don't know if you could expand upon, maybe what they are, how they're used, what's maybe changed over the last 5 years, if anything, around the reverse mortgage industry.
Sure. So we write quite a few reverse mortgages, and they're used for various purposes. As a matter of fact, I did one for my grandparents who had a significant amount of financial investments that were doing well. And nobody in the family needed a house. I mean, nobody really wanted to be left the house.
Right, yeah.
The investments.
It's another great...
Yeah, it really is.
Exactly.
Yeah.
You never think of using it that way.
Yeah.
That's a really smart way to use it. Go ahead, sorry.
No problem.
Yeah.
So the investments kept trading and doing very well for them. And you can use it on a purchase or refinance. So they did on a purchase. I think they put $50,000 down on the home. They get to live in it the rest of their life.
Yeah.
And even if they exceed the life threshold, insurance kicks in, and they'll never owe anything on that house, even if it's upside down on equity.
Well, yeah. Could you just kind of walk
I was
back a
gonna
little
ask,
bit and just let's go through the basics
Sure.
of a reverse mortgage. How does a reverse mortgage work? Pros and cons.
Sure. So they're insured based off life expectancy. And that will determine how much you either have to put down or how much you can get back. You can take it almost like a cash out refinance or a distribution.
That's kind of the way I look at it.
Or a distribution monthly. So you can take a lump sum or monthly distribution, and it's based off how much equity you have versus your life expectancy versus how old you currently are.
Okay, so just to pause there. So reverse mortgage is someone can pull equity out of their home in one of two ways, either a lump sum or a monthly draw.
Correct.
Could they also use it as like a pool? Like, okay, I don't want a monthly draw. I don't want a lump sum. I just want a line of credit sitting there in case I need it.
We don't offer a line of credit in the reverse mortgage. It's
Just
usually
curious.
based off the draw.
Because a lot
not
of people,
to say that they're not
a lot of
available
people
out
would
there.
think of that as like, okay, look, I'm pulling money out. I don't necessarily need it today, but I want that revolving line open in the future. If I never use it, great, but it's there if I need it. That would be an interesting way to use it as well. Yeah.
Now, most reverse mortgages, at least all the ones we offer, are government. They're HUD.
Yes.
So they follow FHA, Fannie Mae, Freddie Mac.
Correct.
So they whether it's a draw or a lump sum, then what happens? When is it? So it's not paid back during their lifetime, or what
It is
happens?
not. So they're not responsible for any payments, principal and interest. Well, I take that back. It comes out of the equity.
Okay.
So the payment is actually coming out of the equity monthly. It's being drawn down. The borrower is responsible for taxes and insurance on the home.
Okay.
So the only way they can be foreclosed on is if they don't pay their taxes and insurance.
So is it safe to say, okay, look, I have a $700,000 home. I take a $250,000 reverse mortgage. Hence the name. It's growing. The mortgage is growing instead of typically we pay them down.
It is,
yes.
but you can never owe more
than the value.
Than the value.
Okay, because you said there's an insurance premium that you pay. Is that at closing? Like, is it part of your closing costs, like this insurance? And what I mean by that, I guess, is, let's say, for instance, that same thing, $700,000 house, I take a $300,000 mortgage. I live another 20 years. The housing market collapses. My house is worth $600,000. I owe $700,000. God forbid I pass. My kids, hypothetically, I'm $100,000 in debt. Do my kids owe that?
No. So
Okay.
it works just like mortgage insurance.
Okay.
If you don't put 20% down on a property
Yeah.
and you default, the
Okay.
mortgage insurance picks up a certain portion.
So it's like almost like a PMI.
Exactly.
Okay.
And so, yeah, and then when you're advising people about pros and cons, though, I mean, in your opinion, it's pretty good. I mean, it's a useful tool here and there, or it's something that people really should consider. I guess, yeah. Do you have an opinion on how not popular, but how good of a tool it is?
So, me being in the industry since 2005, I've seen about anything, everything,
Sure.
and about every reason under the sun. So, there's a good product for everyone because everyone has a different situation,
Different need.
situation, family situation. And it really comes down to somebody like me and talking to somebody like me to really evaluate, and put different options in front of you and your family to decide, is this best for me? Is this best for my family? So there is a person, there's a place, there's a time exactly for it that is ideal. I mean, I think it's a great, wonderful product, but it's not for everyone.
Okay. And so, and along those same lines, I mean, so when you're, I guess, it does Main Street Home Loans, I mean, do you guys kind of come up with your own financing? Or I guess I'm just trying to think of like, when it comes to all these different options like HELOC and reverse mortgage and all that stuff, is it something that you can kind of shop around and find the option? Or I guess, how do you learn about all the tools that you then eventually present to the client?
So it's a little bit of both.
Okay.
We are a direct lender. What that means is we have our own products, whether it be conforming, non-conforming. We have our normal conventional, which means you follow Fannie Mae or Freddie Mac guidelines. We have our government, so we write FHA, VA, USDA. We also have our own portfolio, which means they're our own products we keep. We're also correspondent, which means we write it, we fund it, but it has an outlet it immediately goes to. We also broker, which means that there's some non-QM, which means qualified mortgage, some very unique products out there that we broker more in line to what you just said. Do you shop it around to see who has the best product on it? That's more of a broker. And there are products that we do broker, but we do quite a bit in-house. I'd say probably well over 80%, if not 90%, is our products.
And this is something you mentioned about 2005. So literally, it almost feels like it would probably take a good decade to learn all these different options, if not more. I mean, if someone is just entering the industry, how long do you think that let's just say I'm out there and I'm like, oh, hey, sir, how long are you in the industry? And if someone says, I'm in there for 3 years, it's like, ooh, they might not know as much as obviously someone with 10 years. I mean, I guess in your opinion, how hard is it to kind of wrap your head around all the different options, especially when you first start?
Sure. I mean, I've done quite a bit from credit analyst, commercial. I've wrote bond prospectus. I've done feasibility studies, international and domestic. I started my career with Bear Stearns.
Oh,
and
geez,
then
there it is.
When Bear went under in 2007, I lost my job and worked for Lehman Brothers.
Oh.
Got a paycheck or
Seems
two.
like a good succession.
Yeah,
plan.
so you're right. Yeah.
Got a paycheck or two, and then
They went under?
into commercial for a while. And I mean, just kind of going off subject a little, what we just went through, I think in the mortgage industry was worse than 2008 to 2010.
Oh, really?
At least from what I've experienced.
Well, just like the icing of the market itself, and just like the plummeting of loans.
basically
I do. When
Yeah.
everybody thinks that was the great downfall, I mean, at least we knew why then.
Yeah.
And this was for different reasons
Right.
than it was then. So, when it comes to experience, somebody who's been in the industry and seen, I've probably been through a downswing 3 times now since I've been in the market. And it helps me instruct some of our newer employees, like what to do, how to get through these markets. They're going to come. I think, after this last downswing now, if projections are right, we should ride out a pretty decent market now for a decade or more.
Oh, excellent. Okay, so it's really just sort of reset the landscape, and now we'll gain traction and be able to, especially as you mentioned, if they could continue to cut rates, then the refinancing side of it really starts to kick in.
And a lot will
sledding
coincide
downhill.
with, the market itself too.
Okay,
I
yes, yeah.
I don't know if you guys saw it. Jamie Dimon came
Yes.
out over the weekend and said, if we don't cut spending from the top down, we have 10 years.
Yeah.
So, that could definitely affect it. But if things stay pretty stable in the economy, we should at least be able to ride out a good mortgage industry for the next decade or more.
It's good to hear. All right. So then last question, more on the fun stuff. So, okay. So if here you are spending, Monday through Friday, 9 through 5, if not longer, studying all these different options and conforming, non-conforming, reverse mortgage, all that stuff. So what are we doing for fun? Are we doing this on the weekends too?
What's our do life stuff?
Yeah, right, exactly.
Well, my office, we kind of unwind on Fridays.
All right.
So we do bourbon on Main Street. I keep a bourbon bar in the corner of my office.
Very nice.
And we usually try to bring in somebody local, more like trades or something, and just kind of chit-chat, try a new bourbon. I have to say it's went to the wayside. But I think we're going to bring that back soon. We'll see you guys shortly.
Yeah,
right. Yeah, what was in the bourbon on Main Street? Well, Nate Hartseil, thank you so much. Again, for all of our listeners, it's Nate Hartseil from Main Street Home Loans.
Thank you very much.
We'll be able to put all of his contact information, on the show notes and different things along those lines. But you've been a great, valued partner to SHP for
Helped
years
a lot
now.
of clients. I appreciate it.
Exactly, helping out clients both personally and professionally. So, Nate, really appreciate you coming on the show. And so for all of our listeners, hopefully you enjoyed a little mortgage and refinancing talk. You can always reach out to Nate anytime or reach out to your advisors to learn more. And hopefully you found it informative and look forward to the next time. So be well. Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.